Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is July 13th, 2023. And today we're going to ask the question, did PPI signal the end of rate hikes? If we look at PPI as the preliminary indicator for CPI, PPI is Producer Price Index. Producer Price Index is also considered wholesale pricing. And Producer Price Index usually is passed on to consumers over time. In other words, if cost to producers is going up, they have a choice to either take lower margins, lower profit, or pass those increased costs on to consumers. Well, if PPI is slowing or even going negative, then either the companies are going to make more, have bigger margins, or they're going to pass on some of those savings and relief to grab market share to the consumer. So they can cut prices and try to grab market share in those environments, or they can increase their overall total profitability, which also would theoretically mean continued employment of people that will spend more money on their products. So when we look at PPI pulling back, we saw the expected forecasted rate of 0.2% for the month. It came in at 0.1. Same thing with core PPI, taking out the cost of food and energy. But the bigger thing here is that we're seeing that we went negative 0.4. This was revised lower. We're seeing a lower revision of the previous time frame. If I look at to the month-over-month time period, you can see that we had a lot of inflationary growth, lots of 1%, 1.5%, 0.5% moves up in inflation month over month. And those compounded to be highly negative. But if we look over here, we've had negatives, positives, negatives, positives. We've had about the same number of negative months as positive months in the last year. And it's getting smaller difference every month, but it's still a negative and the revision lower. If you can see that blue hash mark over here, that revision lower from last month tells us that it was not only negative last month, but there should have been even more negative last month. So we're seeing signs that the inflation data is probably predicting out lower consumer costs in the future. Now, Wednesday, we had CPI data report, and it came in at 3% instead of 3.1 and down from 4%. That's the year over year. This is assuming or expecting us to buy into the idea that inflation is only up 3%. That the things you paid $10 for a year ago is now only $10.30. That seems a little bit off. When we're looking at the markets, it seems a little bit off to assume that, but when we're seeing the producer numbers coming in lower, the CPI consumer numbers coming in lower, this is likely indicating or predicting that we do not need to raise rates as has been priced in over the last few weeks. As we look at the actual data, here's your actual data on producers and looking at the difference. And we can see there's a lot of negative numbers here for June. The total of the demand was negative 0.6. May was negative 1.5. You can see the unprocessed goods and intermediate demand, negative 2 and negative 5 for May. And the total changes from 12 months ago, unadjusted, is negative 32.2 for unprocessed goods. So wholesale pricing are down dramatically when we're looking at the commodity prices here, or the wholesale prices that we're seeing from PPI. But as we scroll down, this is what I want you to see. That one of the biggest numbers that we had really was final demand for the services side of things. Transportation and warehousing came down negative 0.9% versus everything else. Energy bounced. Transportation costs dropped. And if we're looking at the decrease and increase through here, we're seeing that we are growing at a slower rate, and that's why that number is in red. So as we're watching the SPY get higher and higher, actually reaching annual highs, we have to go back to 2 years to be able to see that we're near approaching a 2.5-year barriers, resistance levels, and the all-time highs all the way back here on the SPY about 480. We've returned to new annual highs and the levels not seen since April last year. Are we seeing real growth? And if we're seeing that the prices are coming down or the demand is waning and the prices are fading, when we look at copper prices, as you know, is one of my favorite indicators as a representation of demand. And copper prices have had a very strong move today, pushing back up to previous resistance. Now, this is not an indication of inflation. This is, again, treated as more of a demand indicator. So demand for manufacturing growth, et cetera, is pushing higher. And that is why we are looking at this saying, okay, do we have the soft landing that the Fed has promised or have been trying to do? And it does seem like we're changing the picture some. If we look at the TNX, 10-year Treasury yield, 10-year Treasury yield has continued to slide over the last 4 or 5 days. Starting with CPI data, we've dropped, and we've now returned all the way back down from the rally, which is pricing in a 0.25 rally or a 25 basis point rally, all the way back down to the same price levels we had early May. So this is fading the prices in the TNX, is showing that we're not pricing in the rate hikes like we were. Going to the ZQ being the Fed funds rate. ZQ, and for this, we're not trying to look at July. July is still pricing in a quarter point hike, but we want to look out to the end of the year. So as we look at these different numbers here, these are the active months and the future months, and we're looking for these numbers to stop falling and turn back positive. You see 89, 70, 69, 67, 63. As we're watching that number, when it turns back up, December is starting to price in a rate cut. So as we're pricing in rate hikes or holding at these lower levels, it's when we get down to December that we're now pricing in a potential of reversing that monetary policy and bouncing. That's the return to the previous expectations of possible rate cuts by end of year. And according to the CME Fed Watch tool, we're still holding up to about 92. Yesterday was 94% probability of a rate hike in July. But look what happens as we go out to September. September, we're not seeing the same probability of the rate hike, a second rate hike in September, as we were before. We were up at 27%. Now we're back to 12%. So we're fading away from the idea that we're going to have a second rate hike, and is currently only pricing a 13% probability of that rate hike. And if we're going to be between 5.25 and 5.5%, look at what December is showing here. December is now showing that not only are we seeing the skew move this way, but we're now seeing that we're 58% chance of only having one rate hike by December, and 23% chance of a rate cut, and 1.5% chance of 2 rate cuts by December. So we're starting to shift away from the rate hikes off of CPI and PPI. Now, if we're not going to be raising rates, theoretically, financials should slow its climb. It's been climbing. People bet on rising rates helping financials. I think we're going to probably see this slow down. But we are shifting away from what it was looking like we're headed. If we're headed to 5.25%, 5.5%, even as high as 6% interest rates from the Fed, and possibly an 8% mortgage rate, that was going to really hurt real estate. If we're now seeing that that's pausing, or if not pausing, reversing, we're going to see real estate continue to recover off of these lows and move higher. You can see we've created higher highs, higher lows through here, and just in the last 3 days, we broke out, cleared the previous highs, and today is trying to push through this level, which means we could see real estate XLRE go back to its previous highs, and I'm going to be targeting about 41 as my first target. That's about 10%. That also plays into home builders. As much as I want to short the home builders, as much as I believe we had a top in there, if we are pricing in no inflation and no need to raise rates, then there's a higher likelihood that we're going to be cutting rates, and the market is pricing that in. We're seeing it push all the way back up to the highs. If we're seeing no rate hikes being priced in, then there's no reason why the overinflated prices, low cost to borrow that are going on in the housing market won't return with a vengeance. And so as we're seeing those new highs, 87.99, I'm not looking at this as an opportunity to fade just because it's a small body. I'm watching to see, are we going to see those rate cuts move up from December into November, or even the pause happening at July's meeting saying we're only going to do one more rate hike. Now, be aware, be prepared that if that rate hike is followed by another rate hike, then we will correct back down into this 81 area, 82 area, because we need to price back in that rate. This is the pause being priced in, or the potential of only one rate hike. And that means we'd have to go back here if we're going to have 2 rate hikes, and possibly back here if we're going to go 3. But right now, it's climbing, it's strengthening, and as long as the expectation is followed up with the reality of only one rate hike and possibly rate cuts by the end of the year, home builders are going to should continue to climb. Now, that means if we're not raising rates, we should continue to see gold go up and the dollar go down. As we're looking at gold, barely moved today, but the dollar was obliterated. The dollar was really knocked down. Gold is up here trying to break out through here. I'm not looking at that as a strong breakout, but I'm seeing the dollar being decimated by the idea that we're not going to be raising rates any further. And so look at this. Gap down, gap down, gap down, gap down. The US dollar is now at its multi-year low. You go back here on the 3-year weekly chart, and we have to go all the way back to April, the same time frame we just saw on the SPY. I don't see a strong support bounce here. I see the oversold behavior for the year down in this area, but until the US dollar gets fully extended, fully sold off down to about 98, I'm not looking to be long the US dollar, which means I do think equities will have a continued lift. And part of the reason why I'm looking for that is, if you recall, what we can do is we can go to studies, edit studies, and put a correlation study on. Here's a correlation. And with the correlation study, compare the dollar index to the SPX. And what you'll find is there's an inverse correlation, not just recently, but over years and years. We go back all the way back. We can go back 10 years on the weekly chart, and you can see that there's primarily an inverse correlation, where as the dollar is weakening, equities go up, or as the dollar is strengthening, equities go down. We spend most of the time, we only spend a few weeks out of this area every year, where the majority of the time, in fact, in 2023 alone, we've only had 4 weeks that have not been inversely correlated. And we get that inverse correlation as high as inverse 95%. So if the dollar is selling off, then we need to expect that all things that the dollar purchases are going up in value. So let's go back to crude really quick and look at crude prices in conjunction with this move. So as crude prices, we'll leave it on the long term for just a minute. We'll start looking at the very, very long term. Crude has found a support here about 64, 65 right through here. You can see where my cursor is going all the way back to 2018, 2019 highs, 2020 lows, or support level anyway. And we've bounced off of there, returned back higher. I've been talking about this for the last couple of weeks, that my expectations is that crude is going to go all the way back up to 82. And we're looking at crude break out of its price pattern, clear the 77, clear that level through here. That means we might get a pause at 80, but I'm targeting up to about 82, somewhere in this area. Not necessarily the 83 level or breaking the 83 level, but a move back up to 82. If the dollar is cheap, if the dollar is losing its purchasing power, then crude will inevitably go higher. Now, what this does is puts us in a catch-22. Yes, we're seeing low inflation numbers. Yes, we're seeing justification to not raise rates. But if the dollar is getting decimated and crude is going higher, crude will feed that inflation number in the following months. We've already returned off of the lows, and if we measure this from the first trading day of July, right here, and we measure it from that level to the high, crude has already increased 10%. If we get up to 82, that's going to be nearly 16, 17% move higher, and crude will account for probably 3% higher inflation for that 17 to 18% move higher here. This is going to add to inflation in the future months. So be aware of that, but right now the market is reacting to low inflation numbers and therefore lower rates, or at least non-rising rates. And that's what we need to watch for, primarily in technology continuing to go higher, real estate continuing to go higher, financials to slow its growth, but commodities to go higher, and the dollar to continue to slide. Well, that's going to do it for me today. Thank you for watching. We'll look forward to talking to you again next week. Take care.